Financial accounting information, learning objective. Explain the importance of financial accounting information for external parties, primarily investors and creditors, in terms of the objectives and the characteristics of that information. The primary objectives of financial accounting are to provide information that is useful in making investment and credit decisions, in assessing the amount, timing, and uncertainty of future cash flows, and in learning about the enterprise's economic resources, claims to resources, and changes in claims to resources. Some of the most important characteristics of financial accounting information are: it is a means to an end, it is historical in nature, it results from inexact and approximate measures of business activity, and it is based on a general purpose assumption. External users of accounting information are individuals and other enterprises that have a current or potential financial interest in the reporting enterprise, but that are not involved in the day-to-day operations of that enterprise. External users of financial information may include the following: owners, creditors, potential investors, labor unions, governmental agencies, suppliers, customers, trade associations, and the public. The first objective is the most general and is to provide information that is useful in making investment and credit decisions. Investors and creditors are the primary focus of external financial reporting. By meeting the information needs of investors and creditors, external financial reporting provides general information that is also useful to many other important financial statement users. The second objective, which is more specific than the first, is to provide information that is useful in assessing the amount, timing, and uncertainty of future cash flows. Investors and creditors are interested in future cash flows to them, so an important objective of financial reporting is to provide general information that permits that kind of analysis. The most specific objective of external financial reporting is to provide information about the enterprise's resources, claims to those resources, and how both the resources and claims to resources change over time. An enterprise's resources are often referred to as assets, and the primary claims to those resources are the claims of creditors and owners, known as liabilities and owner's equity. The names of the three primary financial statements are descriptive of the information you find in each. The statement of financial position, or balance sheet, for example, is sometimes described as a snapshot of the business in financial or dollar terms or what the enterprise looks like at a specific date. An income statement is an activity statement that depicts the profitability of an enterprise for a designated period of time. The statement of cash flows is particularly important in understanding an enterprise for purposes of investment and credit decisions. As its name implies, the statement of cash flows depicts the way cash has changed during a designated period. While the interest of investors and creditors is in cash flows to themselves rather than to the enterprise, information about cash activity of the enterprise is an important signal to investors and creditors. Financial information is a means to an end, not an end in and of itself. The ultimate outcome of providing financial information is to improve the quality of decision-making by external parties, and in so doing, helping to create a prosperous society. Financial statements themselves are simply a means by which that end is achieved. Financial reporting is broader than financial statements. Stated another way, financial statements are a subset of the total information encompassed by financial reporting. Investors, creditors, and other external users of financial information learn about an enterprise in a variety of ways in addition to its formal financial statements. For example, press releases sent directly to investors and creditors, articles in the Wall Street Journal, and more recently, open communications via the Internet. Serious investors, creditors, and other external users take advantage of many sources of information that are available to support their economic decisions about an enterprise. Externally reported financial information is generally historical in nature. It looks back in time and reports the results of events and transactions that already have occurred. While historical information is very useful in assessing the future, the information itself is more about the past than it is about the future. However, in recent years, accounting standard setters are requiring greater use of fair values rather than historical costs in measuring assets and liabilities. Externally reported financial information may have a look of great precision, but in fact much of it is based on estimates, judgments, and assumptions that must be made about both the past and the future. For example, assume a company purchases a piece of equipment for use in its business. To account for that asset and to incorporate the impact of it into the company's externally reported financial information, some assumptions must be made about how long it will be used by the company, how many years it will be used, how many machine hours it will provide, and so on. The fact that a great deal of judgment underlies most accounting information is a limitation that is sometimes misunderstood. We assume that by providing information that meets the needs of investors and creditors, we also meet the information needs of other external parties. We might be able to provide superior information if we were to treat each potential group of external users separately and prepare different information for each group. This approach is impractical, however, and we instead opt for preparing what is referred to as general-purpose information that we believe is useful to multiple user groups, or one-size-fits-all. The accounting profession believes that the value of externally reported financial information is enhanced by including explanations from management. This information is often non-quantitative and helps to interpret the financial numbers that are presented. For this reason, financial information, including financial statements, is accompanied by notes and other explanations that help explain and interpret the numerical information.